So the purpose of today's video is breaking down what leverage is, what is high leverage, what is low leverage, and which one is better in a very understandable way. I'm going to break it down for you in a way that a 5-year-old could understand. Okay? So imagine they have two builders. Builder A, which has low leverage, and builder B, who has high leverage. We're going to use Lego blocks for that whole example. Okay, so builder A can only borrow 40 extra blocks, which is a 5-to-1 leverage. Just now, before I even say that, builder A has 10 Lego blocks and builder B has the same 10 Lego blocks. So both builders have 10 Lego blocks. And builder A has low leverage. He can only borrow 40 extra blocks. He has a 5-to-1 leverage. The total blocks available for him is 50 blocks. He can borrow 40 plus he have 10. He must use 2 of his own blocks as a promise for every 10 blocks he builds. We're going to get into that. Just stick with me. So that's builder A. Builder B has high leverage. He can borrow 990 extra blocks. He has a 100-to-1 leverage. The total blocks available to him is 1000. The 10 blocks he has plus the 990 extra blocks he could borrow using his 100-to-1 leverage. He only needs to use one of his own blocks as a promise for every 100 blocks he builds. So that's builder A right there. That's the 10 blocks he has, right? The Lego blocks is kind of like your money in your account, but we're going to look at it from Lego blocks perspective. You have 10 Lego blocks, right? To borrow, he needs 2 of his own Lego blocks to get 10 borrowed blocks because he has a 5-to-1 leverage. So we're just keeping that in mind. Builder B, on the other hand, has 10 Lego blocks and he only needs to use 1 Lego block as a promise for every 100 Lego blocks he borrows. Okay? So that's the Lego blocks, that's both of them. What is a promise? So that's how leverage works. Okay, so somebody is basically borrowing you blocks. Think of it like a loan. Somebody is borrowing you Lego blocks, your big brother. We're going to call your big brother Didi, in fact. He's borrowing you blocks. So with the blocks he borrows you, the Lego blocks, you have to put up a little bit of your own blocks as a promise. So just in case something happened, he could take the blocks you use as a promise to recuperate himself. Think of it like a loan, like a deposit. So you have to deposit a little bit of your blocks to get a lot of blocks, which is why builder A must have or must deposit or must promise 2 of his own Lego blocks in order to get 10 blocks from his big brother called Didi. And which is why builder B needs to promise 1 of his own blocks as a promise for every 100 blocks he borrows from his big brother Didi. So now that we have that out of the way, both builders want to build the same castle that requires 20 blocks, right? Both builders want to build a Lego block castle that requires 20 blocks, but both of them only have 10 blocks. So that means they will need to borrow or use the leverage to build a castle. So there we have it. As we can see, builder A promises 4 of his blocks, because remember he has to promise 2 of his blocks for every 10 blocks he borrows. So if you want to build a castle, he has to promise 4 blocks to get 20 blocks. Right? So builder A, low leverage, he uses 4 of his own blocks as a promise. You could think of promise as a margin, but we're getting into that. Just think of promise as a deposit right now to build his 20 block castle. So he uses 4 of his own blocks as a promise to build his 20 block castle. He has 6 blocks left for other projects. We could see an illustration right here. That's the blocks. The yellow blocks is the blocks he promised, and the blue blocks is borrowed from his big brother called Didi. And that's his big brother right there. His big brother have a huge amount of blocks. to borrow to people. That's Diddy right there. That's Diddy. Diddy Combs. He just have blocks. He have blocks and blocks and blocks. So he borrowing you blocks, but you have to promise him, you have to put up a deposit so he could borrow you all these blocks. Simple. That's all what it is. Now we're going to Builder B. As we can see, Builder B only uses 0.2 of his blocks as a promise so that he can build a 20 block castle. Because remember, Builder B only needs to use one of his blocks as a promise for every 100 blocks he builds. So he only uses one Lego block as a promise to get 100 blocks from Diddy Combs, right? So he uses 0.2% or of 0.2 of one block as a promise to build a 20 block, the same 20 block castle. He has 9.8 blocks left for other projects. That's the block he promised. 0.2. I cannot show it in a visual, so we're just going to use one block, right? That's the block he promised, and that's the block he promised down there, and that's the blocks from Diddy. Alright, that's the blocks you get from Diddy. So both build the same castle, but Builder B used way less of his promise blocks. Now we're going to get into why that's important. Let's get into some real definitions right now. Okay, so let's get into the real definition of what leverage is. Leverage in Forex is the use of borrowed capital. Remember, borrowed capital, you're borrowing blocks from your big brother Diddy, typically from your broker. Think of your broker as Diddy with all these blocks that he could borrow to increase your potential return on investment. It allows you to control a large position with relatively small amount of capital, like Builder B. It allows him to borrow 20 blocks and he only needs to put up 0.2 of one of his Lego blocks, right? The Lego translation. Leverage is like borrowing your big brother's Diddy massive Lego collection so you can build much bigger castles than you could with just your own small bucket of blocks. So let's use Trader or Builder B as an example. If he wanted to build a 20 block castle by himself without leverage, it would be impossible because he only have 10 blocks. But with 100 to 1 leverage, he could just put up 0.2 of one Lego block to get 20 Lego blocks from his big brother. I hope it's sitting inside of your head. I probably repeating the same thing over and over again. But leverage kind of a little bit hard to understand. I myself couldn't even understand it after I do that whole. So that's why I had to do that whole scenario so you could understand before we get into the real terms. Okay? So let's do the math. If a broker offers you 100 to 1 leverage, it means for every $1 of your money, you can control $100 in the market. That's the practical leverage example. So with $1,000, you could control $100,000 position. Okay? We get into why that's important. Let's explain margin. I told you we was going to get into margin. So margin is the amount of your own money that must be deposited. Remember, deposited or promise. You have to put up, Builder B have to put up one block in order to get 100 blocks from his big brother called Diddy, right? So margin is the amount of your own money that must be deposited with your broker to open and maintain a leveraged position. It acts as a collateral against potential loss. Lego translation. The margin is the promise blocks. Remember the promise blocks? Alright, let me show you all the promise blocks. Trader B, that's the promise block. He promised 0.2. Let's use fucking Trader A. He promised 4 of his blocks to get 20 blocks from his big brother Diddy. He promised 4 of his blocks so he could build a 20 block castle. Right? So yeah, that's what it is. Margin is the promise blocks you give to your brother to hold while you play with his Legos. If you break his blocks, he keeps your promise blocks to fix the damage. Right? Let's go into the math. Using 100 to 1 leverage to control a $100,000 position, you need to put up $1,000 of your own money as margin or collateral. So if that 1,000 get lost, you will automatically your big brother basically going to take that $1,000 because you put it up as collateral. So if that $1,000 going to a loss, you're going to take that and close you out of the position. But we're getting into that. We're getting into that. Alright? It's kind of starting to get a little bit iffy. High leverage versus low leverage. The technical difference between the two. High leverage, 100 to 1, 200 to 1, 500 to 1. You get more borrowing power, can control larger positions with less of your own money. Think of Builder B. He controlling more blocks with less of his own blocks. Lower margin requirements, less of your capital is tied up as collateral per trade. So after getting that 20 blocks, Builder B has 9.8 blocks left for other projects. He has 9.8 blocks left to build other 20 block castles. He have more money left that he could trade with, rather than Builder A that only has 6 blocks left for other trades or other builds. Okay? So that's that there. Example, with $1,000 and a 500 to 1 leverage, you can control up to $500,000 worth of currency. Let's go into low leverage. Low leverage comes in terms of 10 to 1, 5 to 1, 2 to 1. You get less borrowing power. You can control smaller positions relative to your capital, higher margin requirements, more of your money is locked up as collateral per trade. So they have some trades you just cannot take because you don't have the leverage to take that trade. Right? And that actually happened to me back in the past with MT5. But we're not even getting into that. Example, with $1,000 and a 10 to 1 leverage, you can only control up to $10,000 worth of currency. So let's get into the main point of the whole thing, right? The real superpower of high leverage when used properly, because you can use high leverage in a very bad way. You could just leverage your whole account, risk 100% of your account using high leverage, and just hope that you win the trade to make bank. But that's not how we use in high leverage. That's not how a professional using high leverage, right? Let's get into the main point, the safety buffer power. Builder B has 9.8 blocks free to handle emergencies. So if Builder B loses the trade, let's say Builder B, the 20 block castle Builder B build just crash. He still have 9.8 of his own blocks to build more castles. Builder A on the other hand only has 6 blocks left for emergencies. So if his castle crash, if he Builder A castle crash, he only have 6 blocks left. So he do have more opportunities. It keeps most of your capital free as a safety buffer, right? The multi-castle power. Builder B can build 10 different 20 block castles around the neighborhood, whereas Builder A can only build 2 castles before running out of promise blocks. High leverage equals more opportunities without increasing your risk. You can basically do more with the little that you have. Think of Jesus with the fish. You only have 6 bread, but you're making that expand, you're making that work for you, you're making that stretch. Think of juice. You adding water to that juice to make 5 bottles of juice from one bottle of juice. Right? So more room for more treats. That's number 2. Number 3, the precision power. Builder B can build tiny, perfect 2 block decorations. I hope you're seeing that because my face probably there. Builder B can build tiny, perfect 2 block decorations, while Builder A can't build anything smaller than 10 blocks. High leverage equals finer controls over your projects. Now that's what I want to get into. That's one of the biggest points. You trade with precise small position sizes. So for example, if you have low leverage, they have certain trades you cannot take. Like for example, you're scalping and your stop loss is only 2 pips. Your stop loss is only 2 pips. With low leverage, most times you would not be able to take that trade because 2 pips on, let's say, $1,000 account with a 2 to 1 leverage, you don't have enough margin to take that trade. You could test it out. I don't know, but I know that's the main point. All right, that's the main point there. That's the main point. Okay, but with a higher leverage, you could take these smaller, precise trades with a 2 pip stop loss and still risk 1%. So that's the whole point I getting into. Higher leverage giving you more precise power. You getting to take smaller positions. You're getting to have more precise stop loss. Your stop loss don't have to be 50 fucking pips. You check it? So the cost saving power. If there is a billing fee per castle or per lot size, builder B pays less because he uses less promise blocks to build the same castle. High leverage equals lower cost for the same outcome. It reduces transaction costs through smaller lot sizes. I know with my broker, which is Funded Next, it charges $7 per lot size. If you're using higher leverage, you're using less lots to take the same exact trade. If you're using less lots, that means less commission. That means more profit to you. If you have lower leverage, that means you're using more lots to take that same position. Okay, so that's the whole thing about leverage there right now. I don't know. Tell me if you'll understand. I kind of understand it. I don't say I kind of understand it at 80% there. I being honest with you, like 80% there, right? Like the whole Lego blocks thing give me a different view on it. I 80% there, but they still have that little, that little 20% that kind of, you check it. Yes. So probably next time I do that definition, I'll probably give you an exact example with fucking lot sizes and how the change in the lot size based on the um based on the leverage size. So you could actually see it in practical view. But yeah, that's it for today's video. We did.